G'day guys, it's Jake here. Nothing in this video is financial advice. Please do your own research when it comes to investing. Please be sure to check out the links below, including exchanges I use and social media content that I post. All right, let's go. So today's video, the topic we'll be talking about is the upcoming CPI numbers for tonight in Australia, AEST time, at 10:30 p.m. So coming out very shortly in about 4 hours roughly. We get the CPI month over month, year over year for core and in normal inflation. Okay, so we have previously was 2.9% for year over year numbers, and the estimates are 2.6%. Okay, month over month, it didn't do anything, it stayed flat, and the estimations are to stay flat. Okay, and 3.2% consensus. And previously was 3.2% year over year for core, so unchanged for that one. And month over month for core inflation. So yeah, they're not really seeing any changes at all in these numbers at all, except for the year over year numbers, which is what everyone's got their eyes on. The CPI, everything, not core, which gets rid of food and energy, which is absolutely ridiculous. So measuring inflation properly, not really, but it's, take it, that's what the Fed looks at, okay? So if you disagree with the numbers, then take it out in the Fed. And that's what they look for. And they want it to end around 2% on average, and it's at 2.9. If we do see a significant fall to 2.6, that'd be right just where they want it, in the 2.5 percentile. And if it goes higher or stays the same at 2.9, and the Fed's probably not going to cut as aggressively as everyone's thinking, or 50 basis point, or 25 basis point cut is what's really priced in at the moment. Okay, but I'll show you the CME Fed Watch Tool probabilities for rate cuts. So the probabilities for the CME Fed Watch Tool, the rate cuts coming up very shortly in a week's time. Okay, Fed meeting, and you can sense here, seeing that the majority of people predicting 67% are a 25 basis point cut, and then a 33% chance of a 50 basis point cut. So 50 versus 25. What will we get? It's only a guessing game, but it's favourable towards the 25%, a 25 basis point cut prediction there. And these inflation numbers are really, especially the total inflation, CPI, if it comes in below, especially 2.6 or so, something around there, it'll definitely give the Fed leeway to cut. And also it all depends on other factors too, what they see ahead, but they don't really look forward. They look backward. They're always data dependent. So yeah, to me, it looks like a 25 basis point cut is set in stone. 50, well, something terrible has to happen in the bond market to really signal that. But yeah, so far 25 basis point is certainty. So on to the stock market, okay, and I just want to just go over some Fibonacci and measurements, okay, where price has gone to. So you can see from the 2022 right at the start of that year, the high it made, the wick, to the bottom is correction in 2022, of course, the inflation that they had to prevent and tackle with high rates. As you can see, we wicked right down there in October 12th, which is quite interesting. That's my birthday, by the way, October 12th. So wicked right to my birthday, which is quite interesting. Wow. Anyway, from the top to the bottom, and you measure it out, and as you can see, the 1.618. So it says gold there, the 0.618, but the 1.618, okay, above the one level, and looking at high predictions, it has prices hit it. Okay, as you can see there, right there, it's right at it. Okay, bam, smash the target, and yeah, that could be it for the stock market. This Fibonacci target could be the last gasp, the double top, and then boom, we go lower. or we go even higher to 2.618, okay, which is at 7,000, just thereabouts, and it can keep rallying and going higher. But with the recession around the corner and bad economic data, like the jobs numbers, and yeah, I don't know, it's not looking like it's probable that we go to 7,000. I think we do correct before that happens. Eventually, we will get there, in the future sometime, but not before a correction. Okay, so I reckon the target has been hit, 1.618. Okay, and as far as gaps go, there's no gaps left. The gaps have been filled, as you can see. These recent gaps, this gap here got filled, of course, but there's no gaps above, so pretty right to go down. And look at the Nasdaq. Well, before we go to the Nasdaq, at the MACD as well. So you got this red line here. So you got a high. I draw it out properly. High, high, and high. You see 3 highs, okay? And the MACD, it's going lower. So you can see you've got a high, low, and lower high. I think probably if I change that to orange, you can see it a bit better as that's going down. The momentum is slowing down, the MACD on the 3-day, but the price is going up. So, yeah, it's looking quite weak, and momentum is starting to struggle, and it should really roll over very soon. Okay, so that is that. Got another projection here, and it's very much the same. So from the top, okay, this top was a bit sooner. Okay, the Nasdaq was a wick, but it did come, within very similar days to where the S&P did. Nevertheless, we did get a wick up here at November 2021, and going into 2022, at the same day as October 12th, your birthday. Anyway, correct top to bottom, and you reject it out, and the 1.618, still that perfect wick that just tapped it. That just tapped it there. You just see that, overlay it, and we've hit the rejection, and that's it. The only thing that's not it, I'm not 100% certain that we are going down just straight away, is you do have a gap up here. Okay, it's a gap, you can see right here. It hasn't been filled yet. This one nearly filled it, but we didn't quite get there. We break this trend line, okay. They've been forming since the end of 2023, and it did break. It looks bearish, making it a lower high. That high is lower than that one, and this low is not lower than this one, okay. This low is intact. This uptrend is still going, as far as I'm concerned, until this low gets broken. This one here gets broken at around 17.5 or so, 17.435. That gets broken, then yeah, this gap probably won't get filled. Maybe just go lower, or we go a little bit higher to fill this gap, and then see you later. And it's all over for the markets. That is another way to look at it. So the gap on the Nasdaq has not been filled, but the gap on the S&P, there's no real gap up there, so that's fine. S&P is ripe and ready to go down, but the Nasdaq isn't. Okay, so yeah, wait on that one, and then you look at the MACD, and you can see consecutive lower highs, the same as the S&P. So you got higher highs, 1, 2, 3, higher than each other, and then same as S&P, 1, 2, 3. MACD is going down. So I call it a 3-drive MACD divergence, and it's very, very strong. It goes back to 2023, and it's very wide. So yeah, it's not looking quite pretty, that one. And as I said, we hit the 1.618 rejection. We wick to it. So we could see a little bit more upside, fill the gap, and then it's all over. Lights out. That's that one. DJT, the Dow Jones Transportation Average. So it's similar to the Dow Jones Industrial Average. This is a transportation sector. And we've been calling up, been squeezing in this triangle, okay, ever since the big wick top in November 2021, down to 2022 September, and then we break way up to the top here, and came down, and we've pretty much formed from this point, okay, from this point in October 2023, of course, and it's squeezing. Prices really getting tight, and decision time Whether it breaks the downside, I've got my targets down here, or we go the upside. And yeah, it's a matter of time what really happens, but who knows? I have no idea. But yeah, if you look at the Fibonacci retracement from the wick to the low, and we really haven't reached this 0.786 yet, okay, and this near level. But it's evident in this pattern. It doesn't have to. As as soon as it breaks this uptrend, break these lows, it's lights out. It's over. So that stays that chart there. So it's really decision time. It's really squeezing. And I'll show you the MACD. And you can see is that these are like equal highs, and it's lower than that one. And it's the same as the MACD. That high is lower than that one, because you can see there, these ones are like equal. So really, it is following price pretty closely. So hard to get indication of where that one wants to go. But if the stock market's going to fall, this will have to fall. Okay, that's just how it is. It could fall before the stock market or after the stock market, or at the same time. Who knows? So it's that one. Now we've got the Russell 2000 small cap index. So the small caps from the top here, November 5th, 2021, to the bottom, and October 25th, 2023. Okay, so the top to the bottom, we did in the other charts, and we've got to the 0.786, okay, rejection. As you can see, the wicks here never closed above it on a candle basis on the 3-day, and we got to the 0.786, which was this level here as well. A very strong level, and if we get above that, we break this high. Okay, if you break this high and get above the 0.786, then we are bullish. Okay, and off to the races from there, and we'll retest these highs. Okay, whatever happens there, I don't know. Or what I really see playing out is we could come up a little bit more, and then come back, touch this line, and then it's all over. Okay, and eventually lower levels, and then bam, down here, right down to the bottom. I see him revisiting his lows pretty soon, not too long from now, going into 2025, to get a brutal correction in the markets and a recession. Okay, not what anyone wants to hear, of course. Everyone wants to be bullish and cheery and send our bags to the moon, but when reality kicks in, you just got to tell it as it is, and what you see in the data and the charts don't necessarily lie. The charts especially are pretty accurate. The data can be fudged and manipulated, but you just got to, do just some further investigation and do further due diligence in your research to find out if what's really going on in the economy, and the markets will eventually catch up to what's the reality out there, because markets can diverge from the economy, like you can see in the stock markets, and they're going up. Well, the economy's not doing so well, especially the labour market. See it's going up, and the economy is reflecting a different story. So when the labour market really gets really weak, the unemployment rate starts to go up, and then we'll see the market roll down. Okay, it catches up to reality. So that's that one on the small caps and where I see it going. And then we've got the housing sector. So the housing market looks very strong compared to the stock market. Looks a little bit stronger. We're at nearly at the all-time highs here. A very, very strong, trend over time, as you can see. Very like the stock market, but this is the housing sector. And from the 2021, so May, so we topped a little bit sooner than this period here in December 2021. They peaked a bit sooner. Okay, from the top there to the wick bottom in June 2022. All right, and you can see when you measure it out, we've smashed past the 1.618. You struggled there. See, you struggled. You can see it's perfectly lined up there, that level. Absolutely perfectly. See that? Wow. So wick, struggled and broke through, then retest, came up, down, faked out, and then back up again. So we've gone through this level, and look, it can still go higher. That is definitely certainty. And hit the 2.618, and that'll be it for the housing market, And I don't see it lasting much more than that before a brutal correction happens in this market, because not all markets are immune from a recession. No, you're not. You can't be. So this could really rip higher, and make its final rally up before it slides out. And then I do see lower levels, potentially even to here, the 300s. But I have these yellow lines drawn out, so support lines, they break. I'll cancel them out as we go along. But yeah, the housing market is getting close. And we look at the MACD. The MACD doesn't look too good. So you've got a high, this cluster of highs and this high. So basically, I'll draw it out for you. 1, 2, 3, 4 consecutive highs. All right. And if you go to the MACD, I'll draw an arrow. You've got a high, lower high, lower high, and lower high. So consecutive lower highs in momentum on the MACD, which signals this is a 4-drive MACD pattern on the 3-day. So pretty bad that it's going to run out soon. This trend's going to absolutely turn over. And I don't know when, but you can see we are crossing, just about to cross on the MACD. To wait and see what happens there. But, we can still correct. All right, and then go higher. Like, there's different ways it can play out. Nevertheless, I do see getting the 2.618 eventually. If it doesn't hit, if it fails, that's because the stock market is coming down. That's the reason. And the Nasdaq fills its gap, like I mentioned here, fills the gap, and then comes down. Housing market has room to run a bit higher. Okay, we'll have to wait and see how strong it is, but yeah, anything's a certainty, all right? Anything can happen. And we'll get the yields to finish off. And, you can see we had this big trend line here in the yields. And, you touch here, big consolidation area. We came back to it. And we came back to it here. So 3 touches. All right. And eventually we just fell off a cliff. Just shot to the downside. And we had these support levels. So we had one here, this first cluster, 4.13. And we just smashed it. Came down to this level, which was the second. This lot of wicks candles in April 2023, and we wicked to it, and we shot back up, and we basically to break down and a retest of this level, and then bang, straight back down again. Classic price action, and we're actually breaking right through it. It is not holding up very well at this level at all, and we're shooting right down pretty aggressively as we talk. It's coming down pretty but nasty. 3.569%. And this is really a signal for the Fed to cut. And how bad this gets, it's looking pretty bad at the moment. Okay. Because this is what you really need for the Fed to cut. This is very closely tied to interest rates. Okay. And I'll quickly show you that. There we go, that one there. And as you can see, the 2-year, if I go on the weekly, it's a bit clearer, a bit easier, a bit more zoomed out. I'm going to show you more data points. As you can see, they're very correlated. Here you can go, this period where it was flat, the rates were flat, and they started to yields go up before the rates go up, and the rates followed. Okay. And they flattened out, and then the price consolidated a bit above this trend line, and then boom, it fell off a cliff, and it's only no time before the cuts kick in to follow the yield. You go back to this period in 2018, we had yields fall. Keep fall. I was going down without a hunch of this is certainty. There's rate cuts were coming. Like, it was just inevitable. Like, it just way surpassed the Fed was seeing, and the banking sector, particularly the repo facilities back in that time in 2019, and what happened is they had to cut in response to it, but they saw yields going down before that anyway, so there really was trouble in the bond market, and they had to cut, and then boom, you can see it just folded pretty closely there, but the bond market did lead the cuts there. If you go back to history, You can see how correlated it is. It follows it pretty well up to the point there. And the last recession here, 2020 recession and this recession, the great financial crisis, and you can see that yields were sort of consolidating, but were falling slightly. And then they started to fall and break the support line. They fell, and then the Fed cut shortly after that, and then boom, they both fell down, and they both go up, they both go down. It goes up here, and then rates stay flat, and it goes back down again. Okay, so there are decorrelations. It's not perfect. It's not exactly 1-to-1, but it's very, very closely. So the cuts and the yields go down, it goes back up, so it flattens out, and then bam. So, and then you look back to the 1990 recession, and the yields go up, and then they cut, then bang, 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 and then just as rates go down and the yields go down together, boom. It's quite evident there. Back of that one, then the 20, and obviously the dot-com bubble. Before the rates come down, the yields were just falling, and they had to cut in response. Okay. So, yeah, that is the correlation between the two. And there's a 2-year yield. And look at the 10-year yield. And same thing. It's got this trend line. And we've broken it. And this support level. And we've broken it. And we're coming down aggressively on the weekly time frame. And it's a matter of time before the Fed really respond. Okay. So that is the bad yields. Bond market signaling that times aren't as good. And you can see on the 10-year minus 2-year, we have uninverted. Okay, with 0.06. They've been inverted since July 2022 to now. So over 2 years, very, very long inversion. Okay, and it inverts, uninverts. And what happens when that happens? We get a recession. So it inverts, it's slightly inverted there in 2019 and 2020 were a recession. Okay, inverted here, 2006, we had a bit of an uninversion, but came back down. Then it went again and just shot up, and then recession. 2008, same thing as in 2000, inversion, uninversion, recession, 2001, okay, I should say. We had a fake one here, so it didn't really, there was an outlier there, the late 90s. But the unemployment rate was going down, so it wasn't the problem. Okay, so yeah, when unemployment starts to spike and take off, and in line with yields, it's not a good combination. And this inverted, uninverted recession in 1990, and then we had back to back in the 80s. So you had this one here, 1978, inverted, uninverted recession, inverted, uninverted recession. So back to back. And yeah, this is 10 minus the 2 year. So definitely recession is on the horizon. So that is that. So I hope you enjoyed this video. Just going over the upcoming CPI numbers and coming out in very, very soon. See if they come in better than expected, like lower, or come in flat or higher, which would be terrible for markets if CPI goes up. But I do see them coming down in line with the bond market. That's what it's signaling. And I also look at the commodities market as well. Oil's is falling off a cliff. Oil's is plummeting right now. And copper's not looking so good. So the economic weakness is showing up. And these commodities usually lead the inflation. Typically they do. They do work pretty similar the way they move. So yeah, it's seeing what I see in the commodity market, it's not looking quite good for the inflation outlook and how much downside we can see in the inflation, which is a good thing for people buying goods and services. You should see that come down, but it's not good for the assets. Of course, assets go down as well. And yeah, that is that. And then we looked at the different charts, stock market charts, the housing market. We looked at Dow Jones, SPX, NASDAQ, Russell, and the bond market to see what's happening there and the correlation between the bond market, the 2-year yield, should say, and the interest rates. And they're very, very closely correlated. Also 10-year yields, and seeing they're just falling off a cliff. And yeah, the 10-year minus the 2-year, and that is signaling the recession is around the corner. So it's uninverting right now, and it's not a good sign. So that is the video, and I hope you enjoyed it. If you did, please smash the like, comment your thoughts below, subscribe and stay updated. Be sure to check out the links below, and I'll catch you in the next one. Cheers.